Hello, everyone, and welcome to your Glassnode Onchain report for week 27, 2022. So, we're going to look at a very, very interesting dynamic and a divergence that we've seen playing out in the Bitcoin market at the moment. We've essentially seen the worst month on record. Well, not quite on record, it goes back to 2011, but back then Bitcoin was $10. It's a very, very different time. So, we've seen one of the worst months really in modern history for Bitcoin. But simultaneously, we're watching an expulsion of all of the tourists in this market. If you haven't heard that term, we'll describe it in a bit more. But simultaneously, a different behavior pattern coming from the hodlers. So there's this divergence between two different sectors of the market. And we're going to use a number of tools to really explore this concept further. So as I mentioned, we had one of the worst monthly price performances in history, down 37.9% in June, and it has been pretty grim along the way. Now, over the course of bear markets, what generally happens is you get an expulsion of people who never really understood the asset, people who are here just for the speculative hype. In most of the time in the investing circle, you often hear them referred to as tourists or fair weather investors, people who come just for the bull and the good times. They don't do the level of depth of research. They don't have the same conviction. And what bear markets are a process of is people gradually filtering out. As prices go lower, more people capitulate and sell. As prices go lower, this process repeats and repeats until the only people left in the room are the people with the highest conviction, people who've done the research, that have the overall understanding of the asset. They know why they're here. So this really for Bitcoin is the hodler cohort. You'll hear them referred to really as the strong money. They're people who essentially come into the buyers of last resort. They believe in what Bitcoin is and they're not going anywhere. So we're going to look through this bad price performance and what it actually means. We're going to explore how we can come to this conclusion that there really are no tourists or very few tourists left in this space, using on-chain activity as our primary tool. And then we're going to look at the very interesting divergence here, which is that exchange balances continue to outflow at a very, very aggressive rate, the largest in history, in fact. And simultaneously, we're seeing shrimps and whales continue to accumulate at the most aggressive rate in some time. For the shrimp, it's actually at the largest rate in history. So we're going to explore this interesting divergence from a few different angles. Now, as always, please do give us a share and a subscribe and a like. It does really help this channel get to more people. And again, we're going with a reformed dashboard structure this week, so hopefully you find this one useful. And please do let me know if you're enjoying the new dashboard layout and format. Let's get started. So starting with a bit of an overview of monthly performance. What I have here is the monthly price chart, and what we're looking at is the performance both to the upside and to the downside. So we can actually see how this current month of June that's just closed has actually performed relative to history. And what we can see is that this minus 37.9% performance, you have to go back to 2011, and it's not really even close. 38.5 is the worst we have on record to find price history that was worse than this month. This is a historically bad month. And when we think about what I said in the introduction, that generally negative price performance shakes out the weak hands, there's two things that will generally shake out weak hands. Negative price performance, because people see their asset going down, and eventually that level of loss just becomes too much. And the other one is generally time. And these things both happen side by side. Sometimes markets, particularly bear markets, can go on for such a long time that people just get bored. They get tired of waiting. And both the combination of time and negative price action, of which we have both in play right now, starts to shake people out. And all that you have left is those high conviction hodlers. So you can see that this is a dramatic month. It kind of shows that when we've got this level of price action over a sustained period of months, we're starting to get to the point where if you're still here, you probably understand a little bit more about Bitcoin than the average bear. So this is where this market starts to approach that type of level where we're really shaking out almost everyone except the hodlers. Now we're going to start with active addresses, but we're going to look at a number of on-chain activity. You'll hear me talk about this concept. This is almost like a pillar in on-chain analytics, and I personally use it quite often. And that's the concept of how active is the network. You can think about this in terms of the overall network effects. If lots of people are using it, it's generally more constructive. And during bear markets, we get the opposite. We get fewer people using it, shows that there's less activity, the user base is lower, and all of these things tell us that it's probably not quite bull season. So let me just highlight a few things here. With on-chain activity, you'll see the 2017 bull and the 2020-21 bull are both the same. Extreme explosions in activity, more addresses, more activities going on. The network is expanding in terms of its user base. Now, where we start to signal that the bear market was most likely in effect was following May 2021. Much the same as here in early 2018, this enormous collapse in terms of users, which didn't recover. This is a great signal that a bear market may well be in effect. Even though we actually rallied back to all-time highs, note how little the on-chain activity recovered, and we've really been grinding sideways to down ever since. Now, this looks a little bit like 2019. We had this kind of this explosion of activity as the market had that last gasp of action as we went from August all the way to the November all-time high. Very similar to the 2019 rally. We pulled back again, and here we are really consolidating, forming that base. Now, what's important here is this sideways action is showing kind of a persistent price insensitive amount of activity. It's the base load, it's the hodler activity. And you'll see this similar pattern shows up in multiple metrics as we go down this. But really, from the active addresses standpoint, it's this major collapse that triggers a bear. It's really showing that the user base has been massively shrunk. And then it's this process of recovery, which, as you can see, goes through a few stages along the way. And sideways is getting to that hodler territory. We've got the same base load of activity that doesn't really care about price. Now, active entities is kind of the tier 3, the professional version of this. You use a much, much cleaner data set. It filters out a lot of the exchange internals. Now, when we still have activity going on in exchanges, it's still showing that people are depositing in this consolidation. So the two generally map onto each other, but with a slightly different scale and a slightly different level of clarity. So here we can really see the bear market recovery in 2018. It's got this persistent grind higher, bit of an explosion in 2019, but then back into this persistent grind. Now, we had the boom as we came in here to January, and you can actually see that this negative divergence started to form all the way through the topping pattern. There was less activity going on, even though the market was starting to top and getting these slightly higher highs. Now, much the same, this rally we had mid of 2021 really didn't have the legs. We didn't get anywhere close to where we were. And again, this is providing us that evidence that we could very well be, and in this instance were, into a bear market. Now, much the same as active addresses, we've seen this sideways action. It's kind of grinding sideways. Note that we had in 2018 this collapse, this capitulation level where it really does shake out anyone who's left. And we've seen this both with the lunar sell-off, but then also the one on the 18th of June. We've seen two of these such events. So a very similar type behavior to what we saw back here in 2018. Now, another one that we can use to really assess that there's very few tourists left in the market is the entity's net growth. So that same metric we had above, that's active entities. When we have a new entity come in on chain and someone else leaves, if we have 1 and 1, that will net out to be 0. So growth will be 0. So what growth is showing? A higher level is essentially showing that there are more entities coming in and less are leaving. It's the amount that are coming into the system versus the ones that are exiting the system. Now, what you can see is that we had this burst. Here's that burst of activities we came in actually during the sell-off. So through December, January, February, we actually had an explosion in users, but that has since started to die off. Now, we had 2 spikes of activity during the lunar sell-off and then again on January 18. This is most likely people who were exiting the system, but they were matched by people who were actually saying this might be an opportunity coming in. And the entity growth actually expanded, not decreased. So again, starting to speak to a potential hodler base that's in here. Now, you can see that we did dip down to very low levels, coincident with the bear market floor down here in 2018. So very, very light, very low on-chain activity. This is a big takeaway here. We don't have a lot going on. The market is really signaling firm bear market territory across all of these activity metrics. But also note that during bear markets, we have this persistent sideways action. This will often signal things like the dollar cost averages because these entities, they keep coming in, they buy, and on each particular day, there's this representative people who are coming in irrespective of the price, forming that hodler floor. So the fact that we're at these low levels has 2 takeaways. One, the hodlers don't really have many reinforcements. They kind of are the last line of defense. But simultaneously, they are still there. So we're seeing this kind of dichotomy. There's very few tourists left in this space, but we do have a cohort of hodlers that, quite frankly, don't seem to be going anywhere despite the price action, and arguably are actually coming in at a greater rate during these major sell-off events, which is interesting. And we can actually really confirm this. This is one of the most simple metrics, the number of addresses with a non-zero balance. And it's not the most precise metric, but it gives us a big picture macro view. And what you can see is that 2017 saw a massive expulsion. We saw people who came in for the bull and essentially emptied their wallets as the market started to collapse. We then entered the HODLer regime. This is the dollar cost averages, where it just keeps climbing and climbing. It's this slow grind higher. And really, the slope of this line is indicative of that HODLer cohort. Now, we saw the expansions we came in through the top. Now, note how this generally expands to the upside in a big way during bull market tops. This is the hype cycle. This is actually a symbolic of the market getting overheated. This rapid expansion, note the change in gradient. It's exploded into the actual top. Isn't it amazing how people come in the actual top of these markets, and on-chain analytics really allows us to see when that happens. Now, we had a bit of an expulsion during that May, June, July period. It really stagnated and traded sideways. But note that as we got to the all-time high, we started climbing again. And we've really held this upwards trajectory the entire time. Again, we've talked about this over a number of videos over the last couple of months, really, that this signifies that really the people who are here are fairly price insensitive. It's one metric in the whole picture saying that hodlers are the most likely folks who remain. They're price insensitive, and this consistent gradient is really telling us so. There was a little bit of a shake as we kind of had this 18th of July sell-off, but we have continued to rally higher. Sorry, 18th of June. So overall, what we're seeing is that this is most likely a hodler-dominated market, and we have used on-chain activity to really describe this and show that kind of exit of all the tourists. And the only people who are left really are those who understand Bitcoin probably better than most people. And transaction counts is kind of that final piece of the puzzle. You can see that we have these massive wipeouts as the bear market starts. We had this massive wipeout through May, June, July, and we've had this sideways trading action is really showing the base load of hodlers. Now, one thing to be very careful of is that with transaction counts, they're a little bit more nuanced than active addresses and active entities. And the reason being that exchanges will use things like transaction batching. So when you deposit your coins to an exchange, you're an individual, that's one transaction. However, withdrawals increasingly from 2020 onwards, exchanges have been using batching techniques. You may notice that when you get a withdrawal from an exchange, your withdrawal is included with many other customers. They do one transaction, but it sends many, many different outputs that go to different customers. So as a result, because this really started in 2020, the peaks that we see in transaction counts don't necessarily have to get to the same level as we saw in previous cycles to be as significant. This is an efficiency technique. It will lower fees, particularly in the bull market, and we will see that there's improving technological upgrades like transaction batching and SegWit being adopted that will slightly change the interpretation of transaction counts. But that's just a little bit of a fundamental Bitcoin knowledge as we go. Now, carrying on with this theme of exchange deposits and withdrawals, and actually to illustrate the point that I just made, we have the withdrawals down here in green. These are just transaction counts that are depositing coins to an exchange. We don't care about transaction volume at this point in time. We'll cover that in a second. So the number of transactions going into exchanges and the number of transactions going out in pink. And what you can see is that the pink curve is higher because we have individuals depositing, whereas with withdrawals, we have transaction batching. Now, for those of you who are kind of following all of the things that are going on in this industry, there has been some of the exchanges and lenders that have actually frozen and prevented withdrawals and deposits of late, which is not a great development, but it's also something that has been going on. Now, what I want to highlight, you can actually see that these tend to move in tandem. But notice here how the amount of withdrawals in green is trending higher, despite with the deposits trending lower. This is a divergence, and if you can see on this chart, there's actually no instances of this at a similar scale over the last 5 years. This is perhaps speaking to this renewed emphasis on self-custody. People are seeing some of these lenders, they're a little bit unsure, and what we are seeing is that there are more withdrawals happening than deposits. Now, we typically see that things like transaction counts will move with smaller holders. For general understanding, there are typically more transactions that are small in size, hundreds to thousands of dollars, than there are big transactions. Typically, there's fewer $1 million transactions versus $100 transactions. So when you see a divergence like this, it likely signals that there's a lot of withdrawals going on from smaller holders. And we'll talk about the shrimp in a moment, because really what we're seeing here is a potential renewed emphasis on self-custody going on, which, as you can see, we really haven't seen for some time. This is kind of the last time we really saw this was probably back around Mt. Gox, which I'm sure very few people who are watching this video were around for back in 2013, myself included, by the way. And just to really highlight this dynamic, what this chart here is showing is the number of transactions. The green line is 100%, and the red line or the pink line is 50% of all transactions in the network. How many of them were exchange related, meaning deposits or withdrawals? Now, this is an interesting model because we can see that almost 100%, 94% of all transactions in 2017 were exchange related. Kind of shows the peak level of euphoria, the hype, as all of these investors were buying and selling and transferring coins in and out of exchanges. We didn't quite get as high during this cycle. The market is more developed. There's more things like futures markets and derivatives, and it's a slightly different dynamic, but we still got up here to around 80% of all transactions being exchange related. Now, note that during the bear market, we get this collapse. This is the hype leaving, and we start to form a bit of a stable base. It did last for some time back here in 2018-19, and we can see that we're starting to establish a bit of a floor around 50% here in our current market. So it's really showing that we're getting to that point where it's possible. It's not assured, but it's possible that we're now in that phase of a renewed level of activity that's going on relative to our previous peaks. We're seeing that this is kind of the base load. If this really stabilizes and trends sideways, it's starting to again reinforce our point of a hodler dominated market, a stable base load, people who really aren't going anywhere, they're price insensitive. If it keeps declining, it probably signals that there's more flushing out of tourism to go. And that's why we're using all of these metrics in combination to really help describe a consistent story. Now, a lot of that was about the exchange transaction counts. Now we're going to look at two metrics that describe the supply balance. And what we have is a very, very interesting dynamic. So up here in orange is our total exchange balances, and we've seen a significant decline over the last last 2 or 3 years, where coins have really been flowing out of exchanges overall. Now, I'm a big advocate that exchange balances are very important. We can do a lot with them, but you must contextualize them. It's really important. Just seeing an exchange outflow doesn't really tell you everything. We need to look at it in the overall combination of things, and that's what we're going to do in the charts that follow this. So just keep that in your mind. We'll come back to it. But one thing that is quite interesting is, see here in blue, this is our Coinbase balance. Now, Coinbase over the last 2 years has seen significant outflows. And this yellow curve here is Binance. Binance has seen significant inflows. And actually, over the course of this week, we actually saw a flippening. The Binance balance is now larger than the Coinbase balance, which is very, very interesting. It's almost watching this changing of the guard, a flipping of Binance, which is showing out to be the most preferred exchange. Now, the other thing to know is that many of the outflows that we're seeing from Coinbase is almost in this step function type pattern. Now, when we look at where these transactions are going, these are sometimes 10,000 to 20,000 BTC amounts that are being withdrawn in large chunks. And they're moving to brand new addresses that actually aren't associated with any cluster that we have known. Now, what we could be seeing here is actually institutional flows. They could be going into custodial solutions. What we're seeing is these large withdrawals from Coinbase, and they are going into some new wallets that we don't have associated with any other clusters. Now, simultaneously, Binance has a very, very large suite of products. It goes everything from derivatives, they have a global audience and global exchange, and we have seen that their dominance has actually increased to the point where it is now the largest by Bitcoin balance. So we can really dive down and understand what's going on at an individual level for these exchanges to get that little bit more insight. But again, it's really important to contextualize things as we go. Now, speaking of context, what this here is the exchange net position change metric. Now, we will often use net position change metrics in Glassnode, and what we do is a 30-day change. What we're looking at is how has the balance changed over the last month? And this is kind of a rolling oscillator that will go red in this instance when we're seeing significant outflows, and green when we're seeing significant inflows to exchanges. Now, what we have here is a significant outflow, about 145,000 BTC per month. This is the rate of outflows that are coming out of exchanges, all of them combined. Now, obviously, some of those, like Binance, is seeing inflows, Coinbase is seeing outflows. This is looking at the aggregate. You can look at individual exchanges using Workbench, but what we're looking at here is just the aggregate overall. Now, what's interesting is here we can see the May, June, July period. As I mentioned before, this is really when the bear market is most likely to have started. We saw that collapse in users, really people had essentially moved on from that point on. And note this massive inflow of coins to exchange. So within context, this is signifying that there was a loss of conviction during that time and really set us forward into this bear market over time. Now, we saw more distribution going on as we started to top out through the all-time high. Note, this is actually a bearish signal. We're seeing coins flowing into exchanges at the same time that our overall on-chain activity really didn't have the legs to pick up and get to that previous bull market cycle. So you can see how there's a few pieces of evidence along the way that try to signal what's going on. Now, we did see a very, very large inflow during this period. A lot of this was driven by the Luna Foundation Guard liquidating their 80,000 coins. And naturally, there's other people, whether it's miners or investors, who are also panicking during that time. So we saw a large inflow during that period, but we have now seen significant, very, very large outflows with a great proportion of them coming from Coinbase, again, in that almost step function type pattern, which is quite interesting. And when we put it into context, it does look like there's some large scale accumulation going on. And this is where we're going to explore this concept to close out in more detail. So we have three metrics that we're going to look at from now, and they kind of scale up in increasing importance and kind of just understanding different sectors of the market. This is really what I like to do with on-chain analysis. I try to explore the different concepts and use multiple pieces of evidence to tell the story. So as we saw before, we had 144,000 BTC coming out of exchanges. And the question now is, where did those coins go? So what we have is the illiquid supply chains. Now, an illiquid wallet is one that we define as basically a wallet that has no history of spending. Now, this doesn't tell us, it's not like long and short-term holders. Long and short-term holder supply has a probability associated with it. We've looked at how likely it is for a coin to be spent once it reaches a certain age. Illiquid supply and liquid and highly liquid supply are only looking at the wallet type. If that wallet has no history of spending, it will be classified as illiquid. An exchange hot wallet, on the other hand, that has coins coming in and out all the time, will be considered liquid or highly liquid. So we're seeing here that we have a very, very significant, the largest in over, let's actually pull this back to a 5-year time scale. You can see that this is the largest really since 2017. Now note that 2017, you'll see this in a couple of metrics. 2017 was rallying higher, obviously. Here we are trading lower. So the trend is actually in opposite directions. Strangely enough, at the same price, $20,000, $20,000, just coming at it from the other direction. So let's keep that in mind as we explore these two ideas. Now note that the amount of coins going into illiquid supply is some 200,000 coins per month. And this has been over a shorter period of time than this. So this 140 at the peak has been over a longer period, but it's really showing up during this one here. So they're roughly equivalent. If you took an area under these curves, you would get a very similar number. So the takeaway from this is that over the course of June, despite the worst monthly price action since 2011, we have seen a large amount of coins come out of exchanges into wallets that have no history of spending. We also have the evidence above showing that there's probably a little bit of uncertainty in terms of exchanges coming out of coins being withdrawn just for the safety, just allowing the storm to blow over. So we are seeing that there is most likely coins being pulled out of exchanges and put into investor wallets, just waiting for the storm to pass, or perhaps actually because they see value. We don't know for sure because you have to ask everyone, but what we're trying to assess is all these different dynamics and just piece together a coherent story that matches all of the data. Now, in a very similar manner, this is the shrimp balances. Now, I like to use shrimp balances just looking at all of the wallets that are less than 1 BTC. The main reason, sometimes people will say, oh, but whales can spoof them and so on and so forth. Now, yes, that's possible, but it's also quite impractical for a whale to split their balance over many, many 0.1 BTC wallets. It's an improbable scenario. Yes, it can be done, but it is improbable. And what we typically see, this green curve here is again the net position change of wallets under 1 BTC. And this is entity adjusted, by the way. All of these are, which removes exchanges and miners from the mix. So we're only looking at investor style wallets. So we know that coins are going into illiquid wallets. And note here that we have the largest balance growth and net position change is over 64,000 BTC per month going into shrimp wallets. Now you can see that this is actually now larger than the 50,000 BTC per month that we had at the 2017 all-time high. So much the same as the illiquid supply, price is $20,000, albeit trending in the opposite direction, and shrimp are now accumulating coins, adding to their balance at the largest, most aggressive rate that we have ever seen. This is a 5-year view. Let's look at this in all time. You can see that their balance change is significant. It is literally looks like bull market buying at 20K, except at the bottom. So this is just a very interesting dynamic that we are seeing. And again, perhaps this is the uncertainty of exchanges and lenders and things, but it also could be the actual conviction of these small scale holders. It's a very interesting dichotomy that we're seeing. And to close out this story, we're going to look at the other party that's accumulating. By and large, all the other wallet cohorts between 1 and 10,000 really aren't doing very much. They're kind of perfectly neutral. Every coin that's going into their wallet is being matched by something that's going out. There's kind of no change overall. When we look at the whales, however, now this metric here is not looking at wallets that are 1,000 plus. What I'm looking at here is specifically coins that are flowing in and out of exchanges by whales, by entities that have more than 1K BTC. So it's going to be more accurate than just looking at wallet cohorts that are 1K to 10K. So this is actually quite an advanced metric. Took some time to kind of develop, but what we're looking at is coins flowing in and out of exchanges, specifically to entities that are 1K or plus in terms of their overall size. Now, we spoke about that Coinbase outflow pattern, which we've seen it really is kind of representing that, 10,000 to 20,000 BTC clips. These are very, very large accumulation patterns. Now, what you'll see here is that the general trend, note how whale accumulation tends to really follow price. They're actually not bad at perhaps picking and setting prices. They're large entities, so it makes sense that we get these large scale accumulation periods during the bull, and that really softens to seeing an actual outflow or a decline in their spending or an increase in their spending, less accumulation. Here we're actually getting spending during those bear market periods. As we come into the start of this bull market rally, we see that they started to accumulate again and they started to really soften out following the September peak. So you can see that they do tend to have a pretty good gauge on the market. Their accumulation and spending patterns are actually pretty in tune with what's going on. And remember, this is just coins coming in and out of exchanges. Now note that much like the shrimp, they are also in a period of large scale accumulation, particularly as price falls. This is a very interesting dynamic. So just to really bring it back to the dichotomy that we've explored, it's quite clear from the data that we don't have a great deal of tourists that are left. We really are sitting on that baseline of hodlers, and the reality is that price is correcting lower until those hodlers can set the floor. At the moment, price keeps overwhelming the amount of demand they're bringing in because they don't really have any reinforcements coming in. However, we are still seeing exchanges outflowing. And when we actually unpick who those entities are who are contributing to that, we are seeing that the shrimp and the whales are more or less withdrawing and putting those coins into illiquid wallets with no history of spending. So we've started to build up a bit of a picture on what's going on to try and understand exactly what's happening as best we can using all the information that's at our fingertips. So thanks for tuning in. Hopefully you found that particular session useful. I hope that you took away that we can use on-chain data to really explore this thing from multiple layers. What you're looking for is building almost like a detective. You are looking for evidence that proves a story. And what's really important is not going in hoping to find a particular story, but allowing the data to tell you what's going on. So what we've seen is that overall on-chain activity is pretty lackluster. The hodlers don't have any support reinforcements coming in. They are the last ones left. Nevertheless, we are seeing shrimp and whale cohorts being significant accumulators, and this is showing up in both illiquid and exchange outflow data. So we do have a consistent story. What remains to be seen is, can those hodlers, the shrimps and whales, can they hold the line? So thanks for tuning in for that session. Hopefully you found it useful, and I will see you in the next one. Cheers.